Now we want to move on to the first panel to discuss some of the themes that Colin did raise on his slides. And it's my great pleasure to introduce the panelists. So I invite Axel, Ben, Jakob, Sandeep, and Tomas to join me on stage. Axel is a senior partner at Kearney and has been leading its communications, media, and tech practice. He has more than 25 years of consulting experience. Ben is the chief economist and head of public affairs at Vodafone Group. He has been in the digital sector for 20 years and has represented Vodafone with various institutions. Jakob runs the European Telecom Equity Research Team at Credit Suisse. He has been a telecom sell-side analyst for over 20 years. Sandeep is a senior director in SAP's telecom business. He has also worked at Ericsson and IBM and is inactive in different industry forums. And Tomas is a European Government Affairs Director at Microsoft, where he focuses on connectivity and cloud policy. And I am Mani. I am GSMA's lead for global policy research and delivery across a portfolio of topics on digital infrastructure policy and regulation. And thank you to all of you who are here in person here in the Brussels office, as well as to hundreds of others who have joined us online. At least for the first half part of this panel discussion, I will just want to tease some of the themes that have been discussed. But I will also pick up questions from online as well as in the room. So please have your questions ready. And if you're online, please use the chat function to raise your question. And my colleagues who are monitoring the chat function will share them with me. We will start with a couple of questions to each of the panelists on different themes covered in the report. And then at the very end, I have some quick answer, rapid fire questions to add a bit more flavor to the panel. I kindly request the panelists to keep their remarks to 3 to 4 minutes, so we allow a lot more questions to be answered. And I'm going to start in alphabetical order. Axel is also a co-author of this report, so I'll come at the end to him so he can also react to the remarks that has been raised by other panelists. So I'm going to start with Ben. Ben, the report shows that telcos are investing up to 20% of revenues every year to meet the growing demand in capacity, in traffic, as well as deploying new technologies such as 5G. But we also see that the overall revenues of the connectivity sector have remained flat for a number of years, while the network traffic keeps to grow at an astonishing 34% per annum. And post-COVID, there are also huge expectations on the connectivity segment due to the importance of connectivity that has come to light during the COVID era. So how do you reconcile these different trends, and do you feel the two-sided squeeze that Colin mentioned?
Yeah, thank you, Mani. Firstly, thank you, GSMA, for hosting this event. Before I answer your question, also thank you to Kearney for writing the report. I think the only thing that has grown faster than the traffic that you refer to is the complexity of trying to put together the internet value chain. What started, as you said, in 2009 is, I suspect, a relatively simple and linear exercise has become a multi-dimensional, complex project beast, if I put in those terms. So well done for getting the latest report out, and it's a very compelling read. Mani, to respond to your question, before going into the details, I just think we ought to remind ourselves why this matters so much, especially the sector that we're dealing with. And then, you refer to the post-COVID realization of just how important this sector is. It's something we fully subscribe to. We see what we're doing in terms of deploying the digital infrastructure of Europe as the really important part in building a sustainable, inclusive digital society for economic growth, but underpinned by security and resilience. If we keep all that in mind, that really goes to the heart of why these reports matter so much and what we're trying to do matters so much. And so exactly to your point about the returns in the sector, the returns being below the optimal level, and how do we reconcile that? The simple answer, it is a tough job to do. I thought it was very telling in terms of the charts that were presented. You had Colin, you presented the top 8 online players and how they've expanded into a variety of other sectors. The one area that none of them have expanded into was the connectivity part. And apart from, I think, I'm a details person, so Amazon has gone into satellite according to the charts. But apart from that, they've all stayed, they've gone everywhere except into that connectivity. And the returns of the sector might give an indication as to why that is the case. And that is not a satisfactory position to be in for Europe as a whole, as we look to build that connectivity, build those infrastructures for the sustainable, inclusive economic growth that we need. And so what are we doing about it? How do we reconcile that? The honest answer is we are working tirelessly on every side, and I say every side meaning on both the input side, what the inputs to our business, and also on the output side, the outputs from our business. And so just to explain what that means, on the input side, you've already referred to it, Manny, in terms of tower co. So yes, we try to look for efficiencies everywhere. Tower co's, it's an increasing trend, being separated from the core connectivity businesses, with really two purposes. Number one, to try to increase tenancy on towers, get industrial efficiencies. And secondly, there's a potential for finding consolidation at the tower layer. The second area where we really focus on trying to optimize the inputs to our business is on network sharing. We have done some network sharing deals. We think it's an important component of increasing the efficiency in the input layer so that the returns can go up, so that we can invest more efficiently, more smartly. And where necessary, and this is not something that we as a company, and I think nor the industry has hidden away from, where necessary, looking for full consolidation of businesses in markets where simply the level of economic performance cannot justify the rollout of 5G infrastructure, especially which is critically needed. And the other area we work tirelessly on in trying to improve is on another key input to our business is spectrum. I think it's interesting that, again, the chart kind of you presented in terms of capex to revenue, returns, EBIT margins. I think what that masks a little bit there is the legacy of huge spectrum payments, which is also part of suppressing the return on capital of the industry. I think there are improvements. I think if you look at our results, I know Jakob looked at our results extensively yesterday, you will see that our return on capital is improving and spectrum is part of that. Still not to the level we'd like it to be in terms of our WACC, but improvements being made, but spectrum is an area we still need to keep working on. Longer life spectrum, not having auctions designed to extract value from the industry, but rather to put in input value to the industry is absolutely critical. And then finally, on the output side, again, where we work tirelessly, of course, we need to look for new business growth opportunities. And the squeeze you refer to, Manny, where we obviously do feel it, where we'd like to reverse that squeeze whenever we can on digital services, business services, is clearly an area of major investment for us. But at the same time, I thought it was also striking in the charts that, if I've understood correctly, on the communications chart in terms of whether it's ad funded or subscriber funded, communications is pretty much the only part which doesn't represent a two-sided market, although it could be a two-sided market. And that's something we're, of course, looking to reflect in our work in the months ahead, is that there are multi-sided markets, multi-dimensional markets within an internet value chain, and it's important to remove regulatory blockers to the efficient and effective running of such a multi-sided market. And it's in the news, I won't hide away from it, who should pay for the infrastructure, and having multiple parties paying for the infrastructure, we believe will result in more efficient outcomes for the benefit of consumers, for the benefit of businesses, to get the networks that we all need in Europe in the weeks, months and years ahead. And on that note, I'll hand back to you, Manny.
Thank you, Ben. Thank you, Ben. Maybe, Jakob, I can come to you. So the report had a graph on total shareholder returns, and it's pretty much flat, really, for the internet value chain, for the internet access connectivity segment. It has probably delivered the lowest returns among all the segments. I acknowledge that this is really kind of looking at the global scale, and there should be success stories at the market or the entity level that have outperformed this trend in general. And indeed, you have published a research note recently, and you noted that over the past 10 years, the European telco sector has delivered a TSR of 61%, versus the European stock market with a TSR of 147%. As somebody from the investor community and over 20 years of experience looking at telecoms and tech, what is your diagnosis of the situation of the connectivity segment? And is there any kind of better value creation stories at the entity or market level that you like to share with the audience?
Sure. Thank you. And again, thank you for hosting and for the report as well. I mean, I think that there's sort of two aspects to the relative performance of the telecoms industry. You know, part of it is just the fact that other parts of the economy have grown faster, tech has emerged and grown incredibly strongly, and I think that's obviously something to be celebrated, both as consumers and as investors as well. But as you rightly point out, the European or the telecom sector globally hasn't delivered significant shareholder returns for many, many years. And there's some pretty big regional variations within that. The US has done okay. Europe's been particularly difficult. Places like China, it's been extremely difficult. Chinese telcos trade on 2 times EBITDA, so on very, very low multiples, reflecting very high capex levels. So I think there is there's clearly been a very clear underperformance. And I think there's really 3 issues, and I think Ben touched on some of these. It's about the lack of revenue growth, it's about the step up in capex, and the combined effect of those has been the dilution of economic returns. And then I think there's also a point around leverage, and particularly now that bond yields are starting to go up, that's something that's becoming a bigger issue as well. Just to maybe very briefly touch on each of those individually. On the revenue side, I mean, if we look particularly at Europe, revenue growth 10 years ago was minus 10% in mobile, fixed line was sort of minus 5%. It's gotten better, but it's still negative. Both industries are still shrinking a couple of percent. So, the sort of point number 1 has been that there has been no revenue growth in the European telecoms industry for many, many years. And that's despite the fact that we've had a massive increase in capex over the last decade or so. And as the charts allude to, the returns are single digit. Actually, if you look at the full economic returns, adjust for things like tax as well, you're looking at returns that are below cost of capital. And my background before being a sell-side analyst was I was an economist. As an economist, you'd look at an industry and say, how can an industry even exist when it's been destroying value consistently for 10 years? And the answer to that's obviously more complicated, but the consequence of it is pretty simple, which is the fact that the shares of these companies have sold off. I think there's a third point around leverage as well. And I think the issue has been that if you look at the leverage for the industry, it's moved up fairly significantly over the last decade. It's the kind of classic frog in boiling water versus frog in cold water. It's happened gradually, but it's had fairly significant consequences. So if you look at net debt relative to the operating earnings of the industry, net debt to EBITDA, it's gone from roughly 1.5 times before the financial crisis to almost 3 times now. So it's been a big increase in leverage within the industry. And as I say, as interest rates go up, that becomes a bigger and bigger headwind. I think that leverage burden has magnified the issues around lack of returns, but also I think it's held back operators from being able to do some of the things that they probably would have done, to build things like network leadership in some cases. So I think there's really 3 issues there. I think there are success stories, as you rightly point out. I think the US has been a healthier market than Europe for sure. In the US, you've had healthy growth. You've had consolidation. Since that consolidation, you've had an increase in capex from all the major telcos. So this sort of idea that consolidation leads to lower capex hasn't necessarily played out. The US has its difficulties. It's actually seen a pickup in competition since consolidation as well, which is not necessarily what people would have expected. But it is ultimately, I think, it's been a healthier environment where you have had consistent returns above the cost of capital. And as a result, you have had that sort of shareholder appreciation. So that, there's a lot of variation. Even within Europe, there are success stories, and particularly some of the mid-sized markets. But I think if you're looking at the aggregate picture, the 3 issues you've really had have been the lack of revenue growth, despite the step up in capex, and the leverage of the industry.
Thank you, and maybe we'll come back to some of them in the next question. Sandeep, maybe I can turn to you now. SAP is the largest player in the enterprise resource planning market, close to 30% market share. You're also betting on a strong cloud momentum going up to 2025, and relying on on-prem IT infrastructure shifting towards the cloud. And that's really one of the trends also we highlighted in the report, that on the enterprise side, we see a kind of shift towards cloud infrastructure and services. So how do you view from SAP's point of view on the trends shaping the internet value chain? Do you kind of the shift we pointed towards cloud, and then we added a particular segment on that for this year's report? Those kind of shifts, does it resonate with you in terms of your business strategy?
Thanks, Mani, for the question, and Kearney for the report. And some of the questions raised before were quite interesting. You know, Ben and Jakob highlighted the challenges for the industry and why it is so critical. You know, from SAP perspective, as a vendor of business application, making some of the business processes enabled based on the cloud-based infrastructure, the criticality of all this, the access, is quite key. And the question comes is why we have taken that route. So if you take 5-10 years, we're not even dealing with the questions like multi-cloud. We were addressing the questions around hybrid cloud, how to, you know, for example, marry on-prem with the cloud, or even now, I mean, marrying the edge with cloud and providing a combination of all that. Why we have come to a multi-cloud approach is why now we are very confident that this is the way to go. In terms of innovation, we have to look into the customer's shoes to provide them the reliability in terms of multiple cloud, multiple hyperscaler options, as well as the kind of reliability which they could get from applications relying on various hyperscalers, and the agility or innovation which is coming from the cloud-based deployment.
Thank you, Sandeep, and Thomas, to you now. Microsoft has really come a long way since being a personal computing company to now really a cloud computing giant. And one of the key trends highlighted in the report, and I think Colin also flagged it, is that we have a chart on Microsoft where we show that it's expanding into other services across the ecosystem, generally a trend we see across big tech companies. In your case, in the case of Microsoft, you have expanded into cloud infrastructure as a service, as well as content, including the recent acquisition of Activision as an example of it, as to how maybe you're thinking user interface, cloud, and content comes together. So I want to ask you this question: how is Microsoft viewing the opportunities provided by this combination of cloud plus connectivity plus computing?
Thank you so much, Mani, and good afternoon, everyone. Really a pleasure to be here. And first of all, I would like to thank GSMA for hosting this event, and also compliment on the report you have done with AT Kearney. I think first thing to say, you know, Microsoft has been in business for almost half a century, and we've been committed to expanding the internet ecosystem, and it's been a long journey. I think it shows that we have that long-term commitment when it comes to supporting European digital future, and our business strategy when thinking about how we approach the whole internet value chain, I think is a prime example of those commitments. Now, looking into the internet value chain and all the considerations that have been put together in the report, I think it is really important to discuss digital infrastructure and the importance of it. And not only digital infrastructure of telecoms industry side, but all types of digital infrastructure, which are actually contributing to that internet value chain. Now, the dynamics that are actually driving the whole internet value chain, I think has to be looked at not through the branches, so we wouldn't miss the forest, but from that forest level. You need to look a little bit more holistically, and most importantly, by doing so, we would raise everyone's understanding as well of how increasingly complex that internet value chain has become. Now, getting closer to the answer of the question you posed, you know, I read the report with great interest, and I think it has a number of merits, and it rightly depicts the complexity. And the presentation at the beginning of the event showed how internet value chain has evolved, and how many numerous different stakeholders you have within these different segments in the chain. Now, it usefully recognizes these interdependencies. As you mentioned, the different companies are stepping into different segments of the value chain, and it discusses it quite from an interesting angle. Now, I think it would have benefited from a more in-depth analysis before jumping to conclusions here, just because the internet value chain framework used in this analysis, I think it rightly depicts who gets what out of the internet economy. That is the value extraction by each segment of the value chain, but perhaps it would benefit it from depicting also who puts in what to enable that internet economy, meaning the value injection, the investments by each segment of the value chain, rather than only focusing on the access part. So that value injection, I think, emphasizing on that point, it includes both investments, financial capital, but also innovation and the human capital. So both involve a lot of risk-taking. And when you look at it from the holistic perspective, a lot of what the digital platform contributed were the creation of new service categories that did not exist at all if you look at the inception of the internet value chain and through its evolution. So many of the inline services are the prime examples of these, and therefore much of the value extraction, the revenue by the digital platforms are actually the value creation rather than, as they say, eating someone else's lunch. But I think this is fundamentally important if we want to provide that fully fledged economic analysis and impact assessment to depict our increasingly complex internet value chain. I think the reality is that each segment and actor of the value chain invests in the internet ecosystem and pays its own cogs. It's been mentioned in the report as well, so to necessarily sustain and grow its own segment. Now, these cogs also include investments that contribute to the broader internet infrastructure, naming CDNs, subsea cable investments, also done inter alia by cloud providers here. I think I want to conclude here saying that the report really is fact-based, so that is good. It's really noted, and I think we may see some improvements. So to also delve into competitive conditions on transit and peering markets. I think there have been some studies recently done by WIC as well, which we think would benefit from further assessment. And that said, I really hope that this panel discussion will allow us to consider more carefully how we look at the dynamics of the modern internet value chain, so to approach it in a way that would allow us to look at the complexity of it and then understand better how different segments, how different players within the internet value chain took certain risks to step into these adjacent areas within the value chain, so to foresee what actually is coming next and what is ahead of the curve, so to remain innovative. And I think Microsoft is also a prime example how we managed, as you said, from the beginning to move from that desktop company into an innovative company that went way beyond from what it was initially expected from it, and reinventing itself time and again. But I'll be happy to get back to some of these points later in the debate.
Thank you, Tomas. And I mean, you made this point about the complexity of the internet ecosystem. So just to clarify, I mean, what we looked in this report is really the value chain built around the public internet access connectivity. I mean, we recognize that the whole internet ecosystem is quite complex, so we are really looking through one lens of it. But Axel, maybe I bring you in here now, for you to respond to any of the points you heard. Do you want to add anything pertinent to some of the questions and as well as the points that have been made by the different panelists? Thank you.
Yeah. First of all, thank you, Mani. It was first of all a pleasure to do the report and to dig into that topic again. And indeed, it's a complex one. I think first of all, I would like to shed a light in terms of the overall value chain, because I mean, looking back 10 or 12 years on this one, I mean, it's expanded a lot, and I think we can congratulate us all to enable that over the last years. It's 15% growth. We not should only on the downside. It is 15% CAGR, which has grown over the many years. And I totally recognize the colleague just said that there's been a lot of investment, not only on the telecom side, but also like especially on the cloud side lately, which has been enabling a lot of this online services growth, and of course in investments into and a lot of innovation which are happening on the analytics side, on data side, data scientists, and so on along the way. So I think we can recognize that overall. I think what for me was most intriguing actually looking at this report is actually the concentration which we still have if you take traffic as a measure in terms of how that is actually happening. And that there's 8 players actually driving this and actually driving and expanding also from their base on it. And like some of the other investments which the firms do themselves in terms of where they benefit from, for the cloud, where you have a nice business model in order to monetize that business. The telco side is all of that growth is a little bit cut off because there's a limited way of monetizing on the traffic growth, which we actually seen. The way the market, as you pointed out, the two-sided market is not really overall functioning. Now we see a lot of investment into infrastructure. Luckily, because the telcos are investing, luckily we got pension funds investing. But again, taking also your point on leverage ratios and the pension funds, if interests are rising, let's see where the pension funds put also their money in, whether they continue to finance that growth. And that's actually happening in Europe right now, the financing of growth of fixed line infrastructure. That's actually going to come to Americas as well. I think this wave of Europe, of fiber coasts and so on, will also happen in the US. So like the question is that money there or is that money going somewhere else on the infrastructure side? So I think there's a lot of things to discuss in terms of the squeeze, as well as in terms of like finding a fair distribution of value along the value chain to enable that the telcos can do the investments which are required to continue with the 15% growth on the value chain.
Thank you, Axel. Just to kind of note, I mean, you mentioned, one of the striking features of that you found this year was the concentration of traffic among certain companies. When we conceptualized this event, we did invite representatives from across all the segments of the value chain. We really wanted a diverse panel in the true sense of diversity. So we invited streaming companies and social media companies, but not all of them could join us today. So I'm really grateful for our panelists for joining us today instead. I just want to move on to really talk about the economic architecture of the internet. The last time when we published this report 5 years ago, the debate was around the maturing of the internet in 2016. It was a time when the European Commission has issued its first consultation on online platforms. Now, of course, many jurisdictions, just not Europe, the UK, Japan, the US, have all realized that there should be some intervention in relation to large systemic digital platforms. So we are a long way away from 2016. And a similar debate is now happening in relation to network costs, investment gaps, and we hope that this report should be read in that context as a factual contribution to this debate as this debate evolves over the next few years in terms of finding a better economic architecture and a better governance architecture. In the next panel that follows this, my colleague Laszlo will be discussing the governance architecture around it. So I just want to focus on the economic architecture. As Tomas alluded to, and Axel and others, there is of course interdependencies between the different segments of the internet. But of course, what we see is that although the overall value chain has grown really strongly and steadily over the last 10 years, around 15% per annum, within the individual segments, there's a huge variation, with the connectivity segment being one of the examples where revenues have remained flat. There's a question online asking why the user interface segment has grown only at 6% per annum. So maybe we'll pick it up later. So I really want to probe further here. Is this growth story of the last 10 years still sustainable, or do we need a new economic architecture? And Axel, I'm going to start with you this time around. So I'm going to start with the slide that Colin finished. This is around the two-sided squeeze. Yep. Ben mentioned that in terms of optimizing their sector, they look at different options, mergers, network sharing, spectrum assets, etc. So, really looking at this, I guess the two-sided squeeze is really around the question around efficiency on one side, and then the narrowing of the playing field in another sense. Can you elaborate what do you really mean by the two-sided squeeze, and what should telcos consider as they play in this kind of new environment?
Yeah. And I would like to take a look at even a little bit further and draw a picture a little bit more longer term. So you're right, I mean, about the growth, it's minus 1% on telco overall revenues over the years. I think we showed here 11, but this is just because there's a shift of internet access growth, while there's a reduction on all the non-interactive internet related services. So overall, the telco industry has been flat or declining overall. And so that puts, given the pressure on the margin on this one, the telcos, of course, try to, with the whole big capex envelope, try to get asset utilization. That's the way how they actually can monetize best their investment, which they do. They either outsource it, so sell it off, they either share it, or they either wholesale it. So, but all the case is about asset utilization as much in the absence of any merger, which can happen in market, which is always like a little bit restrictive in a sense. So we're going to see, and you see the investment funds going in there. You're seeing on the cloud side, the hyperscalers going in there. So the assets are stripped increasingly either fully or at least partially of the balance sheet of the telco players, and of course, as Colin pointed out, that's also impacting a part of their economic returns. Nevertheless, they still have to invest for all the traffic growth. Whether it's outsourced, then they have to pay for the rental, or whether it's in-house, they have to pay for the investment. It's not going to go away that part, but it's the assets are taking out, and it's a key part of what a telco is made of. So what is left, if you take that, is the service layer. But the service layer, in terms of customer operations, in terms of providing internet access services, if you suddenly have a fragmentation of infrastructures, which we see in fixed lines, so to speak, then you actually play as a telco an orchestrator of this infrastructure. Well, the question is, that's a orchestration, a software play. You need to move your whole system to more a cloud-based infrastructure. There's a massive transformation a telco has to do. The question, can they do that transformation? Or can actually some of the online services player, which actually take away all the other revenue streams from them, actually enter in that, in that space as well? And we saw like some of the acquisitions on that side. So that's a squeeze. So you take the infrastructure away, you actually have the operations part. That operations part has to be massively changed. At the same time, you get to see the pressure from the internet services part going into that one. Not investing into infrastructure, but aggregating that and actually potentially taking that position as well.
Sandeep, maybe in your opening remarks, you mentioned that SAP has adopted a multi-cloud strategy and making use of the hyperscaler infrastructure to do that. So you have migrated most of your services towards the public cloud infrastructure. And telcos are considering it as they move towards open and virtualizing their networks. You also work with telco clients. How do you think about this kind of, if I can put it, the collaborative competition space, the collaboration with hyperscalers as well as competition in terms of service offerings? How do you look at it from a provider as software as services?
No, I will definitely go back to the two-sided squeeze question, where you see customer operations as well as, how the telcos are being squeezed from the top and bottom, but need to focus on the customer layer and how to get most value out of that situation. So we are working on some innovation solutions around that with telcos, because this two-sided squeeze is a relatively constant theme across the industry. Wherever you go, you will face a similar situation. Some cases more or less, depending upon the telco jurisdiction, but it is a fact of life. Some of the larger telcos have some of our larger telco customers, what they have done is they have built marketplaces to focus on the customer operations by relying on cloud-based applications provided by application vendors like ours to connect and build an ecosystem where you have businesses participating with other businesses using open interfaces, public cloud, etc. Some of the other innovation cases I can mention, which are more for future, is also to get around the access layer limitations by, for example, working with other telcos in a more collaborative way. A specific innovation case we are working with Deutsche Telekom is just that. You take up multiple network slices, you combine them, build a common virtual layer, and of course this requires collaboration working across the industry. So you have to enter into a competition situation with other telcos. If you want to avoid the other situation, which was also highlighted in the report, is of a single player dominating and providing the entire ecosystem, rather than the telcos acting with each other as part of the economy with players like us and Microsoft, even to enter into a competition solution to have open internet.
Thank you, Sandeep. Tomas, SAP is one of your partners. I think you partnered with them more than a year ago. Microsoft is also offering cloud-based services to operators in terms of 5G operator core, 5G private network packet core, as well as 5G MEC. If you look at your quarterly results from last month, your revenues have grown around 18%, so just about how the 15% that the overall ecosystem has grown. But really, most of your revenue growth has come from cloud, which has grown almost 30%. So I just want to ask you, I mean, how are you looking at this opportunity of cloud in terms of really, the synergy between operators wanting to virtualize their network and the offerings from Microsoft and this pivot of Microsoft from personal computing towards cloud?
Thank you, Manny. Now, I think that we're approaching that core of the debate here, and everyone recognizes in this room that converging different parts of the infrastructure probably is the way to go to expand on innovation. Now, as you rightly mentioned, virtualization and cloud computing technologies can really help when it comes to the telco sector to develop the scale and that agility that it needs when, for example, elevating 5G security or stepping into cloud services within the infrastructure. Now, leveraging the economics and the efficiencies of the cloud, it proved to benefit many industries over the past decade, and now it offers telecom sector actually the chance to reduce direct capital costs and the ongoing costs of the operational complexity. So I think, and that is to compare with previous mobile technology. So I think with that purpose-built hardware deployed and maintained by operators will increasingly be replaced by more agile, efficient solutions based on software and cloud computing solutions that would, in return, provide that unique opportunity to operators to, again, reconsider how to approach the whole connectivity segment from that innovative standpoint. Now, I think we probably can see that these shifts that are happening now, telco industry being in cooperation quite closely with cloud service providers and cloud infrastructure being an integral part of the networks, really will form that basis for introducing new use cases when you think about cybersecurity, when you think about AI, machine learning, for really increasing the efficiency of the networks. And with that efficiency, as I mentioned before, it will enable to target the direct capital costs and really the ongoing costs of the operational complexity that the telcos have. So I think in turn this can drive that increased competition, innovation, technical excellence, and after all, network resilience and security that I think going forward, when you see that gradual shift from well-established hardware solutions into fully fledged software-enabled solutions will be quite fundamental. And I have some additional observations here, but one thing I want to mention before we move on.
Maybe just one thing here.
Just one thing here. I think when talking about that dual squeeze, it has been mentioned time and again, we should not forget that telco segment has benefited from the growth of that internet traffic. And it enabled the entire ecosystem to innovate. So I think when we are referring to the lack of growth, we should consider other factors as well. And you alluded to regulatory factors and the EU policy landscape that probably is not prone to enable telco segment within the internet value chain to remove those hurdles. And I think Ben referred to that point as well in his previous intervention.
Thank you, Tomas. Jakob, maybe I'll ask you this question. So you have seen that the European telco CEOs have raised calls for financial contribution by large traffic originators, as well as asking for allowing greater market consolidation across different European markets. On the other side, we are also seeing interest in infrastructure assets from private equity firms. As was mentioned, there's been divesting of assets by telco operators, starting with towers, content assets. This week, BT entered into a JV on its BT Sports asset. All of these measures, as well as this move towards cloud, which is primarily converting CapEx into OpEx, impacts free cash flow and possibly the economic value creation. From your point of view, what changes are required to the economic model and market conditions to allow this connectivity sector to create more value to shareholders and other stakeholders?
Yeah, thank you. I think there's sort of, I guess, two bits to that. One is specifically around this sort of idea of, should big tech basically pay part of the capex to the telcos, which is a slight simplification of the debate, but I think sort of the core of it. I do slightly struggle with it because I think at the end of the day, if you buy a bottle of Coca-Cola in a supermarket, you don't expect the Coca-Cola company to pay for that supermarket. And I think there's a little bit the same thing here. At the end of the day, I don't have broadband because I like broadband. I have broadband because I like watching Netflix. Ultimately, it's an enabler for the service, and you'd almost end up paying twice for the same thing. But I think that it's an interesting debate, and I appreciate there's a lot of subtleties, particularly around the asymmetries of information. But I think we do need to be careful that we're not solving for the wrong problem. Just because we perhaps don't have the regulation that we ideally would like in the European telecoms industry, doesn't necessarily mean that it's another industry's problem. I think also there's an important point that Tomas raised earlier, which is around the investment that's gone into tech. And I think Microsoft's a high returns business, Meta's a high returns business, but we tend to just look at the survivors. There's a huge amount of the tech industry that falls by the wayside. I'm sure there are hundreds of Microsofts that didn't succeed. We shouldn't necessarily penalize the ones that do succeed. And when we're thinking about the returns of other parts of the ecosystem, the tech industry looks very different today from what it did 20 years ago. But actually, the telco industry, it's kind of the same players. So when thinking about the relative returns of tech versus telco, I think it is important to kind of bear in mind there's a massive survivorship bias within the tech industry, whereas you don't really have that to the same extent in telecoms. And so it's not always exactly like for like that we're looking at these things. I think specifically around what needs to happen, and I absolutely agree with Ben. I think what do you need to see happen? First of all, you do need consolidation in this industry. You have marginal cost pricing, and as a result, you do have prices that end up being very low. European ARPUs in mobile are 20 euros. US ARPUs are 60. On the mobile side, for fixed line, the average US household pays about $100 a month. The average European pays 30, 40 euros. So, you do end up, I think we have ended up with excessively low prices, and ultimately that's a disincentive for investment in particular, and a big part of the reason why returns are so depressed. I do think consolidation probably would be an important part of that. You do also, Axel mentioned also earlier, the sort of trend towards breakups, so the separation of infrastructure into netcos and servcos. And I think that's kind of the other half of the puzzle. I think, ultimately having these integrated businesses, sometimes, you end up with the wrong shareholders. You can end up with regulation that's more onerous because regulation does penalize integrated businesses. And sometimes, having the and then there's a leverage aspect as well. There's a rating agency arbitrage from, for example, selling towers. It helps your credit rating and ultimately your cost of debt as well. Plus it improves the use of the network. So I think there's a lot of things that need to happen. Ultimately, I think consolidation is an important part of it, but it's not the only bit. I think other things that need to happen are you need to see more rational price actions. You need to see an industry that sort of collectively tries to walk prices up to the point where they do generate returns that are sustainable. Just one final point. I mean, we did an exercise where we looked at what is the return of the industry and what is the cost of capital. And then based on past transactions, what would be the uplift in cash flow generation that you would get if all this consolidation happened in Europe, in UK, Italy, Spain, and so on. And the answer is obviously it would help returns, but it's not enough in itself to plug the gap. So other things do need to happen as well for the industry to sort of get on a sustainable track.
Thank you, and Ben, maybe I come to you to finish off this segment. So maybe I'll frame my question this way. 5G kind of at the initial days at least offers the promise of value creation, not only through a kind of enhanced consumer experience, but also the kind of enabling the digital transformation of the enterprises and capturing the value through that. I recognize 5G is at the very early stages in many parts of the world. But I want to ask you, are you kind of optimistic about this potential of 5G? And what kind of tweaks needs to happen to the kind of economic architecture of the internet value chain for Vodafone and for other operators to really realize the potential of 5G in this way?
Thanks, Manny. Yes, well, optimistic and pessimistic at the same time, if I can hedge my bets. But let me explain why. So in terms of the optimism, look, I think, Manny, you started this part of the panel asking whether the growth is sustainable. I think we're only just seeing the tip of the iceberg in terms of the growth. I think we've moved from a world of people-to-people connectivity to app-based connectivity, and we're going to move into a world of just connectivity embedded in everything we do. Every industrial sector will have connectivity at its heart. It will drive productivity growth. It will drive new business models. Will drive new technologies in themselves, and then drive efficiencies. And I think that growth is very exciting, and for that reason, I'm highly optimistic. We had a showcase here of some of our own digital solutions about a month and a half ago, where we presented what sort of the future of Vodafone might look like, and there was no handsets on display, which was very interesting. But there was a connectivity layer, which was highly exciting, from connected hospital beds to remote patient monitoring to connected farms. So the potential ahead of us in terms of where digitalization underpins every industrial sector is highly exciting, will deliver huge amounts of growth, and is absolute reasons for optimism. On the other side of things, where the pessimism comes in is who's going to capture the value and the benefit of that growth. And this is where we need to take a healthy dose of reality check here. The way we're set up at the moment is the sector, the telco sector, which obviously where we're closest to, is continually to be fragmented, to be broken up in ways as such that the future for Europe in terms of where that value of that hyperconnectivity will go to will not be to the European operators who are investing in the infrastructure as of today, and that should be cause for concern. And I think it's sort of been touched on in the answers to this question already, but I think to sum it up in the most simplest way. The way the telco sector has been set up from a regulatory and policy basis in Europe is underpinned by interoperability, any-to-any connectivity, and a very restrictive approach to M&A. On the other side, the rest of the internet value chain, or at least significant parts of it, have been set up on the basis of a platform with network effects, with a winner-takes-all mentality, with a very permissive approach to M&A. And that's why we've got to the situation today where almost every year the telco sector, given the imposition of regulatory obligations and policy obligations, almost has to run hard just to stand still, to start the race with these big companies in terms of trying to compete in an open ecosystem around the internet value chain. And that, to me, is something that needs to be addressed. And we need to create that the same mentality, and it doesn't mean regulating everyone to death for the avoidance of doubt, so that we can get competition playing out through the internet value chain and not focusing extensively on one part of that value chain through very intrusive obligations, and to the point where who can be in the sector, whether new entrants are subsidized to come into the sector, whether, as I said on spectrum before, all these things add up and mean that we have one part of the sector which can drive European economic growth, effectively being made to run a huge sprint just at the start of a marathon. And that's the challenge for us, and that's what we're seeing, green shoots of hope here. We are seeing the policy debate change and the understanding that the status quo is not sustainable. To your point, Jakob, on can you have an industry with a return on capital below the WACC? The simple answer is no. You can do it for a while, and you can rely on the sunk assets that are there, but at a point in time that breaks, and we could be at breaking point if we don't get a change in the way the industry is regulated. Thankfully, we see the prospect for that happening, and there are, I would say, very good talks going on at the moment. Now we need to see the actions following in the years ahead, and then with that, we will get to the growth which is going to happen anyway, but also a growth which will drive value for the European businesses that we so much need.
Thank you, Ben, for that optimistic note, but qualified optimism. I just want to turn to the room and ask if anyone has a burning question, but not a comment, but if somebody wants to ask a question, then I will. Thank you.
Can you hear me? Yeah, okay, thank you. Thank you very much. I would be tempted to make many comments and so on, but I will not. I will ask a question to, two questions to Jakob and to Axel, maybe. There is one point that was brought by Tomas that I found quite interesting, is the risk dimension. Because now we are in an environment where the digitalization of the economy, the demand is there, and the fact that this traffic explodes is really a sign that the demand is there. And so when we look at the risk of deploying telecom infrastructure compared to the risk of deploying new service and new business, and if you would look at the notion of return of capital, integrating the risk, what would be your comment? The second question is specifically for Jakob, where it seems you like a lot the US model, but if you would then get a holistic view and look at the comparison, what is the benefit for the global welfare, for the inclusiveness, for the social trust, and so on. Because when you look at the ARPUs in the US, I don't think that they are inclusive. If you would look at the service and the coverage and so on, are they so much better or that we have in Europe? Because at the end, I think we can be proud of what telecom operators have achieved in Europe. And so really, if you integrate those dimensions, because it seems to me that we look at a very narrow way of looking at things, but as a global society, what would you say? Thank you.
Thank you for your question. Maybe, Jakob, I can ask that question. The second one, which is really, you kind of highlighted the US market and also maybe the lower pricing in other markets. I mean, I'll add something to that question and say that although in mature markets, many subscribers do have access to internet, as the report shows, almost half the people around the world still don't have access to the internet. So there is this question about whether operators, even if they want to, should increase prices on the consumer side, or whether they should look for optimization and revenue-raising measures elsewhere. So how do you see this kind of this debate around the retail side and the other side?
Sure. I mean, I think maybe if I just start on the risk point first, I think, I mean, ultimately, you know, at some point the expectation is whether it's infrastructure or new services, they need to make money. The time horizon of that and the cash flow profile of that will be different. You know, for a telco, you'll have a very deep J-curve, a very big investment initially, and then probably, you know, for an infrastructure asset, you would expect that it, you know, after a few years becomes profitable. I think when investing in new services, sometimes, you know, the paybacks can be longer. So I think, you know, one of the big differences really is just about when do these things make money? And that's why what's happening right now is so important with the increase in bond yields and basically the time value of money changing. I mean, if you've got a business that makes zero profits for 20 years and then starts making money in year 21, the move in going from discounting that at 6 to 8%, that will change the value of that investment by 1/3. So I think when thinking about the risk, I'd say a lot of it comes down to what's your time horizon? What is the time value of money? And obviously the value of money is changing a lot right now because of the very large increases you're seeing globally in bond yields. So that's kind of how I would think about the risk side. There's a visibility aspect as well, and obviously you pay a premium for that. I think on the US side specifically, and you should always be careful asking about the social benefit to someone working at an investment bank, because ultimately I'm not a politician. It's not really my sort of mandate to look at that. I think, that said, as if I sort of put my economist hat on, I'd say it's ultimately about what's called static efficiency versus dynamic efficiency. I think what Europe's ended up with is a model where we have very, very cheap broadband access, but we also have low levels of investment. So short term, it's a great outcome for the consumer. You have a lot of people in the US who cannot afford fixed broadband because it's incredibly expensive. Just to give a personal example, my wife's mother lives in Atlanta. Her monthly bill to Comcast is almost $600 a month. Price points like that you would never ever get in Europe. And that's, I think from a social benefit point of view, that's probably a good thing. The flip side is, because you've ended up with very low returns, there isn't necessarily the capital there to support future investments. And I think, particularly on the mobile side, you can tell that there is a quality difference in the US versus in Europe. I think on fixed, it's a slightly different debate. But I think, in the US, you've got hundreds of thousands of small cells, for example. I was in Toronto 2 weeks ago, and I went, and obviously they've got pretty extreme prices, even by US standards. But, going from the 20th floor down to the ground floor, you had a continuous signal in the elevator. You wouldn't get those kind of things in a skyscraper in Europe. So I do think in the US, there are clear signs that, yes, the price points are, twice as high, maybe even more. But there is also a much better network. And so ultimately, what is it you're trying to solve for? Is it just trying to get prices down to make it as affordable as possible today? Or is it that you're trying to build, consumer welfare in the long run, and part of that consumer welfare is building good networks, not just today, but 5G, 6G, and 7G?
Thank you. And I think that's probably the crux of the problem. But there's also an online question. I'm going to convert that into, so all of you can answer into a rapid one-word answer question. Okay. So in the report, we show that the user interface segment, which captures hardware, systems, and software, grew at a really low 6% per annum. But of course, there are still more things to be connected. So smartphones in many of the emerging markets, IoT sensors, health wearables, AR, VR glasses. This week, the Google Developer Conference saw the return of the Google glasses. So I just want to ask you this question. What do you think will be the growth driver of connections in the next 5 years? And maybe I just start with Tomas and go. So one word answer, please.
There's no one-word answer, Manny, to this. It's too complex. But I think we should predominantly look into 4 or 5 key areas. And I would identify artificial intelligence, machine learning, quantum computing, cloud computing, and cybersecurity capabilities as a whole. I think combination of those, and whoever will manage to nail those 5, or at least 2 or 3 out of those 5, will probably be capable of delivering that next curve of innovation and enable those adjacent areas that are, for the time being, known unknown, so to speak.
Okay, thank you. Jakob?
I totally agree.
Okay, good. Maybe I'll move on to Ben.
Well, I'll just take a different angle. Manny, you also referred to it. Let's not ignore those that don't have as of today. So the billions of people that don't have a smartphone. So there's also a huge opportunity in emerging markets. to get people off 2G handsets onto 4G, 5G handsets, and linking financial inclusion with that. So that's one big growth area in terms of connectivity. And then, I said, it's when every industrial sector has connectivity in every aspect of what it does. For us, that's a very important part of the growth story ahead of us.
Axel?
Yeah, well, just to the user interface, I think the device side, I mean, the smartphone sales has been only growing by 2% per annum. The tablets have reached some kind of plateau as well, so that's, I think, the driver underneath it. But also that segment is changing, because it's changing from an ownership model to a subscription model, potentially, or a leasing model over time, because there will be more regulation on repairability and reusability and so on. So I think there will be more pressure on that user side. I think in terms of connectivity, I agree with you, the Internet of Things and so on will drive the connections up, the traffic up. Like we'll see probably the next range with VR, AR kind of things. And we have to see, and we haven't discussed the whole metaverse kind of topic, well, how that will impact the internet value chain. If it comes in the way it is hoped, then the internet value chain in 5 years will look significantly different.
Sandeep?
Yeah, I will just add on to this by some of the very interesting use cases which we see are coming from not the typical standard player, like manufacturing companies trying to connect their various manufacturing sites, very unusual type of players. I mean, using, of course, all of this what Tomas was mentioning, artificial intelligence with device intelligence, and bringing it all together. So the growth will come from all sides.
Thank you. So with that, I think we are coming to the end of our time. So I think it's good to finish on a slightly more optimistic note of the future. Can I ask you all to join me in thanking the panelists with a round of applause?